Hello everyone, welcome to our Great British Entrepreneur Awards webinar with our partners Aston Lark. In this webinar, Aston Lark, Martin Camp and Richard Graham will be reviewing the current economic climate. In this session, they'll review the sharp incline in inflation rates and how it is impacting business operation costs. They'll summarise what you can do if this affects you and discuss how to safeguard your business from a loss. There is an opportunity to ask questions during this session. If you have a question you'd like to ask, you can pop this in the Q&A function at the bottom of your screen, and we'll do our best to answer these later on in the session. And with that, I'll pass over to our speakers today, Martin Camp and Richard Graham.
Morning, everybody.
Morning.
Nice to have everybody on board. My name's Martin Camp. I'm one of the commercial directors at Aston Lark. Unfortunately, I've got a face for radio, but not a voice for radio. So apologies for my whining tones. Hopefully, Richard's dulcet tones will probably be a little bit more entertaining than mine. So yeah, looking forward to the chat. So what we were looking to do for today's discussion was to include a number of topics. I mean, it seems to be changing daily, but the impact of inflation that's having on businesses' operation costs at the moment, the impact that the stress in the economy is having on the insurance industry, what challenges we're seeing in terms of client confidence and how that's affecting sort of like the way that customers are buying at the moment, what the impact of inflation is having on insurance coverage, and towards the end we'll be talking a lot more about what would happen as a business if you're underinsured, and how maybe Aston Lark could support you in that challenging area. So the world of the UK at the moment, I was listening to 5 Live this morning, and more doom and gloom coming our way, and we wrote this presentation a few days ago, and the landscape seems to be changing constantly. And of course, we're all seeing operating costs increasing, and there's been a number of factors that are causing this: energy costs, sort of office space, staff challenges. I mean, we've all probably got staff that are feeling the pinch in their home lives, and are hoping to see their sort of salaries increase in line with inflation. It's a very, very testing time, and what can we do as businesses to help with those? Well, I doubt there's a magic wand that we can wave across this. I mean, like reviewing suppliers and reducing office space, looking at sort of hybrid working, just generally looking at the levers that we've got in our businesses to see what levers we can pull to sort of get some kind of control over our operating costs without trying to push these increased costs onto our customer base, because again, as we'll talk about in a second, that will affect the confidence in our customers and make them choose different decisions. The whole piece around employee engagement is really interesting. I mean, how do we support our employees to keep a happy workplace going? How do we help them with their cost of living crisis? It's just a real challenging time, and Aston Lark, we're looking at these ourselves. It's quite interesting that how other businesses are doing it, and I think we'll catch up on some of this a bit later on, and ask what's happening in your world, and seeing if you've got some examples of what's happening in your business. But how do we deal with it? I was at a conference last week, and I heard John Lewis talking, for example, who are very focused on supporting their staff through the cost of living crisis, and are doing that by awarding a £500 cost of living bonus to help them get through. That's costing John Lewis over £20 million to help their staff through that challenging times, and that's coming off the back of a John Lewis results of 6 months of a loss of 100 million. That's got to come from somewhere, and as all of our businesses have got to look at ways of trying to keep these costs down as much as possible so that we can keep trading every day.
Hi everyone. So hopefully the slide that you've got in front of you now is a nice graph that everyone can see titled for construction cost inflation. So I think this graph highlights the issue when it comes to trying to track current rebuild costs. So one of the factors that we'll talk about today is how materials, how labour has entirely outstripped the known indices that we have, or that traditionally that we've used in the insurance world to assess rebuild costs. So things like the BCIS, the Building Cost Information Service, or the General Building Cost Index, these were things that could be relied upon traditionally and historically to assess. It was, the insurance loss adjusters and insurance surveyors' first port of a call when assessing adequacy of some insured. And as you can see, it was fine and something that we could use up to as recently as January 21, which we've got that sort of crossover point where the two main influencing factors in any rebuild calculation, which is labour and materials, started to dramatically outstrip, which sort of made these two, well-established, well-used indices pretty much redundant. So it goes without saying as well that the issue is further exacerbated if the said asset or building, if that wasn't insured for the correct rebuild value in the first place, and we'll share some real-time statistics around this in a moment, it's obviously going to be far, far worse. If it wasn't insured properly in the first place, if you've got the current issues that we're seeing with the construction inflation running at what it is, we've got a bit of a problem. Not sure that a lot of this will come as a surprise to most in terms of the sort of, the spikes that we're seeing at the moment. If you look at the graph, we all know from any work that we've had done to our own homes, and even the fact that we hear a lot of it in the press, that things are much more expensive. So cost of steel, I think we still hear, has increased by something like 60% during this period, and the cost of timber has gone up 40%. On the graph, I wouldn't put too much faith in the future projections from what people think, or certain commentators think that construction inflation will go, because in truth, we don't really know. I remember thinking back to what commentators were saying in 2021, the 2022 construction inflation would be, and they were saying at the time they projected it to be between 3 and 5%. Currently, we're well over double that. At 12%, which is the highest level that has been for over 40 years. So, in insurance, we've used the term unprecedented quite a bit recently with the COVID-19, the business interruption things. But absolutely, in terms of the cost of things from a rebuild point of view, it's massively unprecedented. So it's really not a great time to renovate your home. As I know, it's exactly what I chose to do at the wrong period of time. But it's also not a great time to insure any assets, such as buildings in particular, not unless you ensure that you factor in all the above to your sum insured, and we'll talk more on that a bit later. So got a graphic in front of you here that really sort of talks about hard market, or the impact the economy is having on the insurance industry, and has been for a little while now. So we thought we'd just explain a bit, what do we mean, and I'm sure you've heard these terms from your own insurance brokers at the moment, but what do we mean when we say soft or hard market conditions in insurance? Simply put, it's as per the top of the slide. It's when there's a tipping point, usually caused by a world event, where premiums increase and capacity decreases. Some people will say, maybe harshly, it's when underwriters choose to actually underwrite properly. The fact is that the insurance market stays more in the soft zone, in truth, than it does in the hard. During a soft market, you'll hear a lot of people in the insurance industry that want to talk about the market hardening, but very much there's a lot of things that tend and normally happen for actually make that move from a soft market into a hard market, like we are in now, and we have been in truth since 2020. So the last hard market was, before that was 2001, and then the tipping point moment was 9/11, albeit there was a number of things that happened beforehand that came into play to create that perfect storm for us to physically move from the soft into the hard market. And here you see really all the things that come into play, or that came into play, for the market to truly harden this time into 2020. So I won't go into all the detail. A lot of it is self-explanatory, but things like, we had a storm season that statistically we were only supposed to see once every 100 years, but where we saw 3 in 10 years, causing pretty much £500 million worth of losses in sterling. Despite the press and what we hear about the insurers' response to COVID-19 and the issues that we had with certain business interruption policies not picking up, the insured losses from COVID-19 was actually worldwide 44 billion. And that only put that behind the 9/11 attacks and the Hurricane Katrina in terms of financial scale. So it was a huge seismic event for the insurance industry, as obviously well as the world in general. Solvency II was something that was brought in and required insurers to have, or to need to have, twice the spare capacity or capital over and above their liabilities than Solvency I. There was a change in what we call the Ogden rate, which is something that we use to calculate, or insurers use to calculate reserves on liability claims in terms of special damages that are awarded. And that saw insurers' liabilities increase dramatically overnight. So all these sorts of things, combined with poor investment returns for insurers, goes back to the point we said before, that insurers actually need to underwrite for a profit. If we add in Grenfell, and if we add in the years and years since 2001 of soft pricing of risks, which is what insurers will say, and then you have this sort of perfect storm with COVID, similar to back in 2001, with it being 9/11 that was the tipping point. COVID really was the tipping point in 2020, and ever since we are in this hard market. Martin.
Thanks, Rich. So, I mean, with the insurance industry in that turmoil, it couldn't have come at a better time for customers. And after mentioned earlier, the risk, the factors that we've already seen in terms of increased inflation, increased interest rates, supply chain issues, increased in staff costs. It's putting a huge amount of pressure on business. At the same time, the insurance market is now pulling back capacity and increasing premiums. And I guess what we're seeing in our own business when we're talking to clients is a lack of confidence. Businesses are struggling to make the decisions that are best for their business, how they see fit, and from our point of view, like looking to make decisions about maybe even the kind of insurance coverage that they're going to buy, and making decisions. Are they making those decisions for the right reasons? And how, if they make those decisions and maybe pull back on coverage that they've bought in the past and think that they don't need right now, what's the longer term effects on that business if it does go wrong. What we wanted to do right now, rather than listening to Richard and I sort of waffle on, I think it would be really, really good to hear from the people that are on the call. I think so. Two quick questions. I guess the first one, if in the question box, just to get everybody practicing typing, I guess, like a quick question: has anyone else on the call seen a decline in client confidence recently in their businesses? So quick yes or no. Oh, yeah, thanks. Yes. Okay, yeah, we've got a few yeses coming through. Thank you. Thanks, everyone. would any of the people that have said yes care to expand a little bit more and maybe share some examples of what that looks like? And I mean, if there are any people that didn't put no and just didn't say no, because why would we put no? Are you expecting a loss of client confidence? And if so, what would you think the main driver of that would be? No. Okay. Okay. Anyone want to expand while we're here? We can move on if we're feeling. Oh, there we go. Thank you, Henry. Brilliant. Thank you. Yeah. So I don't know if everyone can see the questions, but Henry was saying in his business, people are worried about spending cash on some new software, due to the climate. Yeah, not buying in bulk as much. Yeah. Spending cash on software and then lose employees. I think that's, I mean, Richard and I have sort of like been talking about this sort of like before the call. I mean, these are definitely the levers I think that customers are looking at, and what choice have they got? They've got to make some real tough decisions. So I guess the economic factors that are affecting the business at the moment, we probably all know them. They've been mentioned a lot. The war in Ukraine, increased energy costs, increased office costs. We've got global supply chain issues. We've got a skill shortage in this country. Interest rates are going through the roof. Brexit's happening. These are all factors that are affecting everyone's business. There is one other thing that I think that Richard and I really wanted to talk to you about, and we've touched on it briefly already today, is the hidden challenge of underinsurance. Richard, I don't know if you could just click on the thing. So the problem 22 and beyond is quite a busy slide. We use the term underinsurance. Thanks, Nicola. We use the term as underinsurance, and Richard will talk through this in a second. But we really do feel that this is this potentially could be another real challenge for business when it comes to how we. Thanks, Hannah. All the responses are coming across. Maybe it's been a bit slow on my internet. So we've got we in the climate that we're going in. I think if you're underinsured, this could be the difference between your business, recovering or not following a loss. We're seeing in our sector, aren't we, Richard? Loss adjusters looking a lot closer at the valuations that customers are declaring at the time that they do their insurance. Richard has spoken already today about sort of like construction costs inflation. The insurance market wants to return to writing profitable business, and to do that, they're going to make sure that they pay out the claims that are insured and probably don't pay out the ones that are not insured. So there's a whole number of factors that, what we were talking about the insurance hard market and the challenging times on the economy. If this bit isn't done properly, then we've got ourselves another problem that we didn't realise that we had.
Thanks, Martin. So Martin's talked about underinsurance, and you can see probably where we're going with this in any case, but there are protections within your insurance policy that you have, certainly in terms of buildings, but elsewhere as well, to proportionately reduce a claim payment for a loss if your buildings are uninsured in the first place. So if you think about it, you're paying a premium based upon per 100, per 1,000 of sum insured. And therefore, if you're found to have, in the event of a loss, not enough cover, then insurers want to proportionally reduce. And they do this by something called average. And it works like this. And this is the same if it is fundamentally your own home buildings insurance, or if it's a commercial buildings, or if it's a second home, or if it's investment property, or if it's something, building insured in a SIP. But the example here is round figures. So you're insured for £1 million. The rebuild value is deemed, because like Martin said, and this isn't just a recent thing to be honest, but loss adjusters in the event of a large loss will want to scrutinise the rebuild value. More so now than ever before. They always have done it, but they are very much looking at it now. In this event, we've got insured for £1 million. We've got true rebuild is discovered to be 2 million. So there's a shortfall or a level of underinsurance of 50%. Most of the claims that you'll have on your buildings will not be total losses. They will be partial losses. So in the scenario that we've got here, you can make a claim, or your loss is 500,000. What insurers do and can do and will do is adjust that proportionally to the level that you've underinsured. So you see here that you've got a loss of 500,000 on your building due to a fire or water damage or something of that that's an insured peril. You're only going to get half of that. And that, how they do that, is built into all of your policies. It's something that we see all the time. You have this condition of average. So the question there is, yep, so I'm insured for £1 million. I've claimed half, or want to claim for £500,000, but I only get 250,000. How does that work? It is due to that proportionate remedy that insurers will apply, because you've only paid a premium according to what insurers will say, and is right. You paid a premium for X amount of cover. You can't be expecting anything more than that. There are certain scenarios that if it is in a total loss situation, we go back to that slide that says £1 million, you will get the £1 million. So if it's a total loss because you are suffering that penalty for not insuring it for the correct value, by only getting the limit of the sum insured. But that only happens in the event of a total loss. People might not realise that. It doesn't happen on partial losses where average will be triggered. So I think, in truth, underinsurance has always been a problem, particularly on buildings insurance. Pre-COVID, I think the figures that were bandied about by insurance and general press was something like, they thought 70% of all buildings were underinsured by an average of around 30%, which is terrifying enough, to be honest. But the truth is actually far more terrifying. And these are real life statistics that we've just put up on the slide now. And these were taken from almost 1,100 valuations that were carried out on our clients. And due to the shift in material costs that we saw on that previous slide, the level of underinsurance on 1,100, so that's quite a decent data set to compare. The level of underinsurance has opened up to 80% by an average of nearly 60%. So you probably looked at the example on the slide before of the calculation of underinsurance, thinking, well, when's that going to happen? It is happening. Thankfully to date, and we'll go into the solution in a second about what we've managed to do to try and tip this back into our favour and to our clients' favour, is we've managed to avoid 262 million of shortfall for our clients. But again, it's a drop in the ocean. Clearly, we have more than 1,100 clients at Aston Lark, and in terms of the Howden Group, and we are rolling this out to all, warning them that this isn't just us being alarmist or being doommongers. This is real life statistics. And we believe the main issue we're seeing is, as mentioned on that previous slide, where the buildings were already underinsured before we started to see these material and labour costs blip the way that they have done. So just what's happened recently has just exacerbated the issue. And as shown there, really, if we were 70% underinsured by an average of 30, it's opened up to 80 to 60. That probably does tell the story by itself. But what was already a bad situation has obviously turned into a truly horrible one. And insurers aren't really doing much about the issue, I suppose, apart from warning clients and warning us as brokers of the implications, which we all know. Certainly as brokers, we do. And historically, brokers also tend to focus more on the warning of the problem rather than actually providing any meaningful solution, which is where us as a broker decided to take the bull by the horns and talk to a company called BCH, Barrett Corp Harrington, who are a RICS, Royal Institute Chartered Surveyors, regulated company, providing rebuild cost valuations since 2006. And we spoke to them and said, look, we want something that is cost effective. So the usual barrier to sorting out or understanding whether a building is underinsured or not has to be a professional valuation, and these can be quite expensive. So we wanted something that was cost less than 100 quid and provided a reliable rebuild valuation that we could then use, which all of those, pretty much 90% of those 1,100 valuations that we've had carried out since April, when we launched the new service, the new desktop service, have been these sorts of surveys, cost less than £100. So whilst the statistics are scary, and they are, these valuations are helping us and our clients tip the scales back into our favour. It's a simple fact, really. The more valuations completed, the less the number of our clients will be underinsured in the event of a claim. And it's as simple as that. And it's critical. Like we said at the start, it's some of the assets, the buildings that we insure are, rather than put into a pension, we're buying investment property. We've got buildings that are insured or that are in a SIP. It's critical that we've got the rebuild valuations of those right, because the last thing you want to do is see a shortfall of 60%,
especially at a time when the rest of the world has gone crazy. I mean, 260 million between 1,000 businesses, that's a big shortfall, and none of those 1,000 people knew whether they were insured properly or not.
And it's not been talked about in the press, is it, Martin? It's no. The facts, as I say, and as Martin spoke about before, we know all the things that we're seeing, the impact of business of current inflation. We don't really talk about this in terms of the construction inflation causing the issues on buildings. For us, we're attacking it as hard as we possibly can do. We've rolled this out to our entire business, and that's the wider group as well. But what I will say is those statistics of 80 and 59% have remained static throughout the launch. So even the first month's results in April and even May were at that sort of level.
I mean, we're hoping that if you only take one takeaway from today, is you look at this. I mean, if you haven't looked at the valuation of your property, be it your commercial premises or even your own house that you live in, if you haven't had that looked at within the last 12 months, you should really do it, because you could be sitting on a real disaster here, and no one's got any spare cash laying around to pick up these shortfalls, especially when we want to be doing other things with our cash to help keep our businesses afloat. Then we've got a team of experts within the Howden organisation that are also suggesting that this number is going up at 1% a month at the moment. So we had clients that were doing the valuation surveys back in April, and already they need to be reconsidering their sums insured. And so it's quite a scary thing that's going on. I've seen that there's some questions come on. We'll pick those up in a sec. Let's do the bit about Aston Lark. Why Aston Lark? I mean, if any of you know Aston Lark as a business, we're a general insurance broker. We employ 1,500 staff. We're we're spread across about 30 locations in the UK, with offices also in Ireland. We're part of the Howden Group. Howden is one of the biggest insurance brokers in the world, and that also incorporates, as well as Howden and Aston Lark, it incorporates A-Plan, who some of you may have seen in your high street. So we really are that insurance broker in the UK that can organise anybody's insurance, whatever insurance needs that they are. We have, with our scale, we have many years of experience in most industries, I would say, across the UK. But we provide that personable service when, you know, we're not sort of call center driven. You know, if you want insurance advice, you get to speak to our fully trained, technically trained individuals, insurance professionals. We have access to every insurer that you can think of, and because of our scale, that means that we can get you know, really good deals. And you don't have to worry about trying to deal with insurers. You know, we as the broker, we would do that on your behalf. I guess, I mean, look, I mean, we're very passionate about not only about doing insurance, but doing insurance properly. It becomes especially with some of these. I mean, the insurance industry got some bad press following COVID and the BI scenario, and you know, I think Richard and I are both strong believers that the insurance industry didn't hold itself in good standing with how that was dealt with, which is why we're very passionate about bringing to life this underinsurance issue. You know, it's really important to us that we don't have to speak to people that suffer because the insurance industry has let them down. We've both worked in the insurance industry all of our lives, and we're very passionate about that. And we're also passionate about getting our team members to act in the same way. So that really is the driving force behind what we do at Aston Lark. You know, we'll share these slides. So there's some words there. There's a testimonial, whatever we call it, from an Aston Lark client. So we can share those. So we've had a chat about the operating costs, how the insurance world has been affected by the current market and the decline in client confidence. We've focused on underinsurance, and we're not apologising for that. We do see that as a real sort of hidden problem. I'm going to have a quick look at some of the questions that have come in. A really interesting one from Hannah about how employers support their employees' financial well-being when they're struggling themselves, and do we think hybrid working? Do we think hybrid working is a good thing to do and can save on costs? I think, yeah, good way to save on costs, or does it create more loss? I think the cost of living crisis is really, really interesting, and I guess every business in the UK is made up of the people that work for it, and you know, if you have a happy workforce, then you typically have a happy client. And there are some real challenging times coming, and we're hearing a number of sort of like stories from our clients that are trying to support their staff in terms of cost of living sort of payments, looking at sort of like salary costs. There's crisis loans, you know, in a way where, you know, trying to provide crisis loans to easily accessible crisis loans, so people don't have to go down to sort of like payday loan lenders and you know, get themselves in a vicious cycle of debt. The John Lewis example was interesting. They were hearing from their partners that they had employees coming into work hungry, you know, because they're really struggling to eat. So John Lewis themselves have now, you know, if you work at John Lewis, they're providing free food. They want you to come in and they want you to eat before you start your shift. I guess, bearing in mind businesses are struggling and it's hard for businesses, any little thing you can do to help, I think would be really, really appreciated, and to try to sort of like consider people's principles, because typically people are not going to want to come to their employer for help. They're really not, and you don't really want them suffering in silence. So I don't know, Hannah, if that helps, but yeah, it's a real tough one. I guess the last thing that employees want is free gym membership and yoga classes. It's going to have to be a bit more practical than that. And I was talking to a business up in Stockport last week, and they were saying that when they were working with the local supermarkets, and the supermarkets are saying how the increase locally of shoplifting, they've noticed, and none of the shoplifting was luxury items. It was baby food, pet food, and sanitary products. I mean, what member of staff in a supermarket is stopping a parent, stealing some nappies out of a supermarket? So it's I think there's a lot going on that we need to be aware of. Cost of living, wage, living hours as well is another area that lots of businesses are looking at. But it is hard. It is hard. The hybrid working piece, Rich. I mean, did you want to pick up on the hybrid working piece?
It's just such a huge subject, isn't it? And I think it really does boil down to the type of business and your workforce, to what the need is. So for me, where I've got a claims team, there are certain roles within that claims team where remote working is absolutely the right thing to do. And the hybrid working, you can attract talent from a wider pool. You aren't fixed to particular regional geographical areas, which is fantastic, and it means you're bringing more talented people into your business. But you do, and I think it's been well spoken about, you do lose quite a bit as well, especially where you're, in terms of culture, and you're trying to build that team ethic, and you're trying to get younger members of your team to learn by osmosis. Those conversations that the more experienced members of the team have about certain claims, that's how we all learn within claims, within insurance. To be honest, there was that old wise sage on the team where you'd hear them have phone conversations, or she had phone conversations with their clients, and you just learn so much. So you are losing, it is about striking that balance, but making sure that you have the right model based upon your team and based upon those roles as well. But whether it saves cost and whether it creates more loss, it depends what you're valuing. Pounds and pence, clearly there are some cost savings there in terms of property costs, in terms of IT costs, in terms of all those sorts of things. But I suppose, as with anything, you've got to do that cost benefit analysis that looks at value probably outside of the pounds and pence as well to your business.
And your risk profile changes a bit as well, doesn't it, Mitch? So if you've got more remote workers, your IT security risk increases. You've also got the added challenge of that. As an employer, we have an obligation to look at the well-being of our employees, and if they're working remotely, are we picking up on those nuances, the mental health issues, the stress issues? All of those things still exist if you're working from home and not in an office, and I think it can be harder to pick up. So your risk profile does change. Yeah, you haven't got someone in the office that can leave the taps on and flood your building, but you don't know what kind of challenges that your staff are sitting on at home and having to deal with at home. So
we know, Martin, of some of our clients that have pivoted from on-site, public walking onto their locations, to purely off-site, and they've done it remarkably well, and the operating costs have come down, and there's been no decrease in turnover because they've managed it all well. It really is dependent upon the business, like we said, and what you're trying to achieve.
Yeah. Rich, I don't know if you see this, but Charlie's saying that they're looking to go out for some investment at the beginning of next year. How do we think the current economy will affect his investment? He's looking for investment in his business.
Good question. And to be honest, I'm not sure I have the answer. In terms of what I see could be the problems for Charlie, I think there is still money out there. I think absolutely there is still finance, equity, whatever way you want to go about it in terms of raising funds. Again, I think it is just at the moment we can't really even look that far forward. Base it upon now, what you can do now, and then see that as and take it on a week by week basis. So I know that's a very poor answer to that question, but I think in all honesty, I don't know.
We did touch on this a little bit earlier as well, and sort of it's an anecdotal story. So forgive me with this one, but I was speaking to someone yesterday who's working in a business that is also looking at refinancing next year. And they were telling us yesterday how they actually are counting toilet rolls now, and looking at reducing the number of toilet rolls that they buy over the course of the year, and what return that saving in toilet roll is. So it can get quite granular when you're looking to get investors in, and they typically want a very lean cost base if they can, which has a number of effects in terms of like staff morale and what you deliver to your customers. So I
think the only thing we say is that clearly people wanting to lend money, they're absolutely still there, but they will scrutinise and take far more time on their due diligence to pore over absolutely every nut, every dot, everything within your business to make sure that you're for them. So the really good businesses, the really attractive businesses with the really attractive business cases, they will still absolutely get the investment that they need. Maybe there's some others that maybe don't fall into that category that might not, or not get as much as what they want.
Is there anything that's going to make employers think twice about cutting jobs if they want to recover quickly?
I think we know, Martin, in terms of certainly in the insurance industry, that it's a candidate-driven market, and as we always know, Aston Lark are as successful as what we are absolutely because of our people.
Yeah.
So they should be the last thing that you're thinking of, not the first.
Unemployment levels are the lowest in the history of the UK. Finding staff is very tricky. We were fortunate enough to have a conversation with some people a few weeks ago, and we were talking about the challenges, and that staff challenges is the biggest factor, I think, at the moment. That's the most obvious one that's coming out, and saving money on staff costs right now, probably as tough as it might be to, it might look quite good for today, but it probably isn't going to stand you in good stead for tomorrow. But I think that wraps us up. I think. I mean, we're unless there's any other questions. Hold on, one more come in from Crystal. I imagine investors will be looking deeply into how the company managed during this difficult time. Yeah.
That goes back to that due diligence point. They'll be poring over that, more so now than ever.
Yeah. And they will probably be as well looking at potential risk exposures within that business. So, and this does boil back a lot to, cyber security will be a big thing there. They will be looking at sort of, is there anything sort of like sitting on the systems that could come and come out of the woodwork in terms of sort of like data privacy leakages and things like that. The underinsurance thing on assets. One thing's for sure, investors will typically not want to take on the risk of an insurer, and they would hope that people have got the right insurance in place. So they should be looking at making sure that properties have been valued and assets have been valued.
And I think in recent times, outside of that as well, we've only focused really on buildings, but we're seeing huge amounts of underinsurance, and it could have created a webinar twice as long. But in terms of your business interruption, which is normally sort of based upon your gross profit or based upon total revenue, that absolutely needs to be looked at, because business interruption in the event of a big, large loss, horrible physical fire or water, that's the first thing that you need to rely on for the safety and for the recovery of your business. But also plant and machinery and just contents. Everything has gone up and everything has been affected by all the things we've spoken about: Ukraine, Brexit, COVID, all the supply chain disruption. We see it on motor claims even, where the delays to get vehicles repaired now is just absolutely huge. We've got some repairers that are not booking their cars in for repair until next year now, the middle of or the middle of January. So it's massive. And we will say as well that that service that we've offered, that desktop valuation service, is open to prospective clients as well as existing clients. So if you want to, if you're building sum insured declared value is less than 5 million, which is where the criteria sort of limits, then please get in touch, and by all means we can offer that to you.
Yeah, I mean, we would love to talk to all of you about your insurance. Of course, that goes without saying, but we would also, Richard and I would personally love to hear that you've all gone and at least looked at your own sort of asset values and just get that checked out, because some of the stories we hear about under insurance is really, really sad. So just at the very least, if you don't do anything else, even if you never talk to Aston Lark ever again, go and get your assets valued, and make sure your insurance will deliver what you hope it delivers when you paid the premium at the start of the policy period. All right, if there's no more questions,
that's Chloe.
Fantastic. Martin and Richard, thank you so much for joining us today and sharing your expertise and knowledge. This session has been recorded and will be sent out to all attendees later on this afternoon, so you can watch the on-demand version. Thank you all for joining us again this morning, and have a great day, everybody.